Hi, everyone. My name is Nick McCoy. I'm a managing director and co-founder of Whipstitch Capital. We are an investment banking firm that works with emerging better-for-you food and beverage companies. We also do some work in personal care and supplements, but food and beverage is the lion's share of our business. Um, we own our own firm, so we can choose who we work with, and we spend a lot of time looking at trends to make those choices because one of the biggest challenges is figuring out if a company is going to be successful or not based on their data story and available white space and what growth they can possibly get. So we spend a lot of time analyzing trends in different categories and subcategories. We can also work with companies as small as $1 million, and we've worked with companies as large as 300 or 400 million. So we have a pretty wide spectrum across all categories. What we do is we help companies raise money, either $10 million or higher in an institutional capital round. We've worked with some larger strategics on the buy side, helping them find targets for M&A and also for strategic investment. And then, of course, the classic investment banking sell side M&A where you get retained by a company to run a process and sell it for the highest price. It's really interesting. I mean, there's a number of trends. I think one of the biggest drivers of all is that the consumer, in the U.S. is becoming more self-aware around food, beverage, and how what they put into their bodies makes them feel, and how it impacts their health. Healthcare is very expensive, so high deductible plans are getting more pervasive. So the more you can do to be healthy, number one, the better you feel, but also it helps save money, and people are realizing that. So with that, there's a lot more new categories of innovation where people have discovered through the self-awareness, hey, I feel better if I eat less carbs at lunch or if I eat more protein as a snack. And so you'll see lots of products that are coming out that fulfill those needs. Cheese has obviously been probably a big benefit of the keto diet. That's been something that's been out there in various shapes and sizes since Atkins 15 years ago. I think simple ingredients, authenticity of brand, craftsmanship, local production are all very big things, especially when you think about higher end cheese. I think those are all, big winners. I think, natural, organic, better ingredients is very important. But I think the quality of the product and thinking about higher end cheeses and kind of, where they're sourced and where the cows are and, how they're made, I think that's almost more important. So one other point that's interesting is about 3 years ago, Amazon, which is turned into a very large food vendor in the U.S., they allowed people who use their seller services. They have two ways to sell. One is seller services, which is basically consignment, and the other is vendor services, or vendor central, where they buy the product from you and sell it themselves at their own price. But seller's the easiest one to access, and that's where companies go first. And 3 years ago, they let seller use Prime, which means that the buyer can get free shipping. When that happened, more than half of the companies out there started selling online before they started selling in stores, which was just an amazing shift. The traditional path has always been that you start in the natural channel because just if you look on average and you average out every single product that exists of healthier products in conventional and natural, each door is going to sell 3 times as much. And that amount is growing right now at 5% a year in natural versus conventional. So it's in the discovery rate, new consumers, they will find a product in natural faster than conventional. They will spend more time looking, reading labels. There's much more opportunity to demo. The scope of the promotion programs that you can do with a retailer is much broader because a lot of these are almost independently owned. And then once you got large and natural, you would go to conventional and more money would come behind, et cetera, et cetera. But we're seeing more and more people starting online and actually growing profitable online businesses before they even get to retail. Businesses that are 20, 30, 40 million in revenue. And this is a really new trend. It's quite interesting. Less so in refrigerated, but I will say we did a transaction with a company which has a frozen product that was able to ship ambient, and they grew up that way online. We're very successful. Yeah, this is a really interesting question. Small brands are definitely growing faster on a percentage basis. And if you look at all of the growth in U.S. grocery here for better for you brands, if you looked at the last 3 years, kind of natural better for you brands are growing at a very consistent pace. I think in MULO it's something like 10 billion a year in growth per year, whereas the conventional products are actually shrinking in total. But at the same time, large brands are much larger, and they can extend very quickly by producing SKU number 41 of the 40 distribution points that they have, and grab hundreds of millions of dollars of revenue in a year, whereas small brands can't do that. So it's kind of a tough question. I think there are certainly some really large brands that are hanging on and doing very, very well, like Philadelphia cream cheese. It's outselling private label 3-1, I think, in velocity. I think millennials are trying to, they're very self-aware. They're trying to find authenticity in brands, and they're trying to find things that are kind of new, new that their friends may not have. And I think there's a distrust toward larger brands. I think no matter what, the larger brands are made out of, and even if they convert to organic or natural, they kind of almost don't believe that a large brand can do that, or a large, company can do that. So I think, the authenticity that you get in the small brand is very, very important. I think that can be maintained as a brand grows. And, there are some very large brands in the US that do that. I would point to just because it's a great example, GT Kombucha, which is a, $200 or $300 million, actually I think it's almost a $400 million brand now, that is the leader in the kombucha category. And that brand remains authentic at its larger size. For the branded product companies, we're seeing revenue levels changing dynamically and also kind of in longer term trends. So there are certain brands that are having a consistent decline, and then there's other brands that are growing very, very rapidly within these large portfolios. And as any manufacturer knows, that becomes difficult because you can get too small for your co-packer or too large for your own plant. So there's a lot of shifting in manufacturing that we're seeing as these revenue levels, reach kind of new permanent sizes. We've seen people do M&A deals because they're getting a plant with a brand. We've seen people, bring brands in-house. From the co-packer standpoint, there's a tremendous amount of demand. Co-packers meaning people who are manufacturers that don't actually own brands, but are manufacturing for the brands. I would say more than half of, probably more than 3/4 of small brands will outsource their manufacturing and continue to do so unless they're in some kind of a sector where kind of holding on to your craft and doing it yourself is really, really important, like cheese making, for higher end cheese. But if you were making simple cheddar, you'd probably be outsourcing it, or yogurt for a lot of them. Co-packers are under a lot of demand right now, and in certain, for certain product types and certain categories, its capacity can be very, very scarce. It's a real challenge. It's really interesting because there's a number of factors at play. The larger branded product companies have an incredible asset where, from kind of the farm to the shelf, they have incredible controls and an incredible kind of chain of management, so that each individual piece is as expertly managed and efficient as possible, with a brand manager in the center. That infrastructure was really designed for, in today's terms, call it billion-dollar brands. And it's been stretched down to $200, $300 million brands pretty effectively, but it's tough to get below there and stay profitable. So if you're, a large company like a Kraft Heinz or somebody like that, you really want to buy a new brand that you're confident is going to get to that level. And because of that, if you're already a larger brand at the $200 or $300 million level, you're going to get a much higher multiple than somebody who's still got a question mark that's smaller. If you're at there was a company called RX Bar that sold a couple of years ago to Kellogg, and RX Bar grew up online. It was profitable because of that. It had significant online distribution and alternative channel distribution, but it was only about 13 or 15% penetrated in conventional grocery. And because of that, it got a very outsized multiple, because Kellogg knew all it had to do was push it out through conventional grocery, maybe build up its convenience business, and you have a large brand. It hadn't even extended beyond bars, and they're already doing that. So there's also a trend now, because not every company is going to be that large, not every brand is, where people are recognizing that early on in brands, and instead of raising, $20 million every other year to grow brands, what they're doing is they're becoming profitable early on, and they're basically either growing up online. You see a lot of this in people who are selling online, which I know doesn't work very well for refrigerated, or they're basically saying, okay, we have this great niche brand, and we know that we've got a $20 or $30 million audience that's willing to pay X. And we know we could cut that price and we could probably get more customers. But at the end of the day, we can also have a nice $20 or $30 million, very profitable brand. And if we can't sell to a strategic, we can always sell to private equity. And so you're seeing more and more of that now too. And there is a trend where private equity players are starting to roll up and combine multiple, call it 5 million EBITDA and up companies to do that. Stonewall Kitchen just sold. Spruce Foods was bought immediately before the sale. I would be certain that pushed up the amount of EBITDA Stonewall Kitchen had for that sale. The emergence or the ability to partner with small companies is something that's really been developing a lot over the last 10 years. Classically, this existed in beverage because you could partner with a smaller beverage company and you had trucks that you could bring them onto, and you'd take a small stake in them and bring them on your trucks, and eventually you'd buy the company if it did well. And that model existed for years within beverage. But now we're seeing it more and more within food. And I'd say in the last 10 years, just about every single large CPG company has developed its own venture program, and usually a separate venture group within it. These venture groups are doing, really kind of two or three things. One is they're looking for food tech in certain circumstances and licensing technology, which they can use in their brands. That usually doesn't lead to M&A. Sometimes they're going out and making a silent investment. So they're just going and investing a couple $1 million in a Series A round or a Series B financing of a smaller company. And they're doing that just to get close to the company, to get to know them. Again, if the company gets large enough and they're going to sell, they're already on the cap table. They're an easy call, and they have a really good feeling if the brand is going to be successful long term. So it's just, it's kind of it's not really buying an option, but it's buying intelligence. I'd say the more pronounced trend now is investing more like, $3, $5, $10 million in, Series A or B rounds, but doing so with the intent to buy the company when it gets larger, if it succeeds. And the scope of the transactions there is very, very wide. You can have everything from, an investment with a right of first refusal to a well-defined, window of time where you have an option to buy with valuation ranges depending on growth, penalties if you don't buy. It's a very, very wide scope of deals. And those are becoming very common, and they're generally speaking not announced. I think the largest driver of increased acquisition multiples is a large CPG company feeling that, 100%, if it's possible, assured that that brand that they're buying is going to be successful in their portfolio of $300 million plus brands. And that means it's either very large and already there, but in most cases they get bought before that. So it has all the ingredients that are going to make it, there. You're seeing so many brands growing. If you look at grocery store shelves, there are more and more brands being added, below 5 million in revenue today, than you're seeing, growing up between 5 and 100 million in conventional grocery. So you have this pipeline of, many growing innovative brands that, quite frankly, right now is growing faster than the large strategics can buy them. And so the brands they are buying are getting larger. And because the brands are larger, they're also paying higher multiples because they're more assured that they're going to be successful. And I also think there's a scarcity of very good properties. If there is a brand that's in a category that is going to be successful, there's probably only one of those brands that could be actionable in that category. So it gets bid up. It's an interesting question. And the answer is not straightforward because at the end of the day, all of the large CPGs face some declining revenue in some of their brands. It's just the legacy brands they're declining partly because they're losing audience or losing customers, but they're also just declining because the store shelves themselves are getting diluted. If you look at the actual number of better for you innovative products that exist on a store shelf in the conventional grocery channel, it's going up at a couple percent a year. And that, just naturally dilutes. If you can think about what the cheese shelf looked like 40 years ago, it was radically different than today, or yogurt. So it's just, there's a natural dilution just by the number of available choices too. So M&A and buying, brands essentially combats that revenue decline and combats the decline in the bottom line, which is associated with it. At the same time, you see some of the larger CPGs coming in and out of the market for reasons like they're over leveraged and they have a lot of pressure to deleverage and pay off debt before they go and spend more money in acquisitions, or CEO changes. You'll see a CEO come into a company like Dean Foods a couple years ago, and they bought Good Karma and they bought Uncle Matt's, and then a couple years later they weren't buying as many companies. So management changes. If a company gets bought by private equity and taken private, that also tends to drive M&A too. Lots. So I guess first of all, I would be proactive and not reactive. And that means figuring out internally where, kind of where your portfolio is short or where you want to add into the portfolio, thinking about the categories and the subcategories that, that exist there, and then actually really doing the work of going into those categories and looking at the different channels and what's happening. One thing to think about too is there is a very wide valuation gap today between the brands that are kind of premium successful brands and brands that need a lot of work. You can buy a brand that needs work and is got a higher risk of failure for probably a quarter the revenue multiple of something that is very successful and growing rapidly. If you feel confident with the resources that you can bring to it and the value add that you have, a lot of those brands don't make it. But if you feel like you have the resources, you can do very well buying these brands. It is a challenge. So the idea of being prepared to pay a premium for a premium brand with less risk is, if you look 5 years out, it generally pays off from what we've seen. I think that the largest risk in food and beverage and in dairy, I think, is probably a little bit higher is liquidity risk. It's obviously a high slotting category. It's expensive real estate in the store, so that drives a lot of capital necessary to get to the point where you're going to be profitable. So if a company has a great investor base, most of these companies take 10, 20, $50 million to get to profitability or exit. If you're going in, you have to either be prepared to fund that or be confident that they're going to get to a level where they're going to be able to raise a $20 million check from one of the larger funds to get there. So liquidity risk is number one, and kind of behind liquidity risk is execution risk. So if you look at the package of what's being sold, and you look at how wide it is, how widely distributed it is, you think about it. Most of these brands go through 3 or 4 package changes between the time that they start and the time that they end up getting to exit. Those are expensive. The wider you are, the more those are going to cost, and the greater the risk of execution. There's a lot of factors that drive value. And again, I think a lot of these factors are things that drive that certainty that you can get a brand to that very high, revenue level. All of those things also help mitigate your liquidity risk as well.